In today's video, we are going to delve into the fascinating world of investing, specifically focusing on the legendary investor Warren Buffett. We'll be exploring his investment strategies during times of high inflation. But before we begin, let's take a moment to appreciate the immense significance of Warren Buffett in the world of finance. Warren Buffett, often referred to as the Oracle of Omaha, is widely recognized as one of the most successful investors in history. With a net worth of billions of dollars, he has achieved remarkable success through his long-term investment approach and astute decision-making. Buffett's investment philosophy has garnered him a massive following and has influenced countless individuals seeking financial prosperity. Now, in this video, we'll uncover the secrets behind Warren Buffett's investment strategies during high inflationary periods. So, buckle up, grab your notepads, and let's dive right in. But first, let's make sure we're all on the same page by understanding what inflation is and its impact on the economy. So stay tuned for a next section. Inflation is a sustained increase in the general level of prices for goods and services in an economy over time. It erodes the purchasing power of money, meaning that each unit of currency buys fewer goods and services. The impact of inflation on the economy can be significant. Here are a few key points. 1. Reduced purchasing power. As prices rise, the value of money decreases, leading to a decline in purchasing power. This means that individuals may have to spend more money to buy the same goods and services. 2. Income redistribution. Inflation can redistribute income within an economy. Those with fixed incomes, such as retirees or individuals on fixed salaries, may struggle to maintain their standard of living, while those with variable incomes may be able to adjust their earnings to keep up with rising prices. 3. Uncertainty and market volatility. Inflation introduces uncertainty into financial markets. Investors become cautious, causing stock prices to fluctuate and interest rates to rise. These fluctuations make it challenging for investors to predict future returns accurately. During periods of high inflation, investors face several challenges. Number 1. Eroded real returns. Inflation erodes the real value of investment returns. If the rate of inflation exceeds the rate of return on an investment, the investor effectively experiences negative real returns. This can limit the growth of wealth and impact of long-term financial goals. Number 2. Risk of poor investment choices. High inflation often results in market volatility and increased uncertainty. Investors may be tempted to make hasty decisions, leading to poor investment choices driven by short-term thinking rather than long-term strategies. Number 3. Changing market dynamics. Inflation can alter the dynamics of various sectors within the economy. Certain industries, such as commodity, real estate, and infrastructure, may benefit from inflation, while others, such as consumer goods or bonds, may suffer. Investors need to adapt their strategies to capitalize on opportunities and protect against potential risks. Warren Buffett is renowned for his value investing approach, which involves identifying undervalued stocks and holding them for the long term. Here's a breakdown of his investment principles and their relevance during times of high inflation. 1. Value investing and long-term focus. Buffett's investment philosophy revolves around seeking companies that are trading at a discount to their intrinsic value. He believes in buying quality assets when they are undervalued and holding them for an extended period, allowing compounding returns to work their magic. This approach aligns well with inflationary periods as it emphasizes long-term wealth creation rather than short-term gains. 2. Intrinsic value and inflation. During times of high inflation, traditional valuation metrics may lose some relevance. However, Buffett's focus on intrinsic value remains crucial. By assessing the underlying fundamental strength of a company and its ability to generate consistent cash flows over time, investors can identify resilient businesses that can weather the storm of inflation. 3. Durable competitive advantages. Buffett places great importance on investing in companies with durable competitive advantages, often referred to as economic moats. These advantages can include strong brands, patents, or a unique market position. Companies with economic moats tend to be better equipped to navigate inflationary environments, as they have the ability to pass on increased costs to the consumers or maintain pricing power. 4. Emphasis on quality. Buffett seeks out companies with a history of strong financial performance, stable earnings, and competent management teams. During times of high inflation, companies with solid fundamentals and a track record of adapting to changing market conditions are more likely to withstand the challenges posed by rising prices. 5. Long-term horizon and patience. Buffett's investment strategy is founded on patience and a long-term outlook. He advises against being swayed by short-term market volatility and instead encourages investors to focus on the underlying value of their investments. This approach is particularly relevant during inflationary periods where short-term market fluctuations can be unpredictable. By maintaining a long-term perspective, investors can ride out volatility and benefit from the compounding effects of their investments. Warren Buffett's investment decisions during periods of high inflation have been shaped by his long-term value investing approach. While specific information about his portfolio during high inflation may not be readily available, we can analyze his historical investment decisions and the companies he has invested in to gain insights into his strategy. Here are some key points. 1. Focus on stable businesses. Buffett has consistently sought out stable, well-established companies with durable competitive advantages. These companies tend to have pricing power and the ability to pass on increased costs to consumers during times of high inflation. 2. Consumer staples. Buffett has shown an inclination towards investing in consumer staple companies that offer essential products and services. These companies, such as Coca-Cola and Procter & Gamble, have historically performed well during inflationary periods due to their ability to maintain demand even when prices rise. 3. Utilities and infrastructure. Buffett has also invested in utility companies, such as American Electric Power and Dominion Energy. Utilities often have regulated pricing structures, which provide a level of stability during inflationary times. Additionally, infrastructure investments, like his ownership in Burlington Northern Santa Fe Railroad, can benefit from increased transportation costs during inflation. 4. Strong brands and moats. Buffett's investment philosophy emphasizes identifying businesses with strong brands and durable competitive advantages. Companies like Apple, American Express, and Bank of America, in which Buffett holds significant stakes, possess these qualities and tend to perform well during inflationary periods. 5. Ability to raise prices. Buffett looks for companies that have the ability to raise prices during periods of higher inflation. By investing in such companies, he seeks to mitigate the negative impact of rising costs on profit margins. Warren Buffett's investment approach during high inflation offers valuable lessons and strategies for investors. Here are the key takeaways. 1. Thorough research. Buffett's success stems from thorough research and analysis. Investors should carefully evaluate companies, looking for those with strong fundamentals, durable competitive advantages, and the ability to withstand inflationary pressures. 2. Long-term perspective. Buffett emphasizes the importance of a long-term perspective. By focusing on the intrinsic value of investments and holding them for the long term, investors can navigate short-term market volatility and benefit from compounding returns. 3. Investment in stable businesses. Buffett's preference for stable businesses, such as consumer staples and utility companies, highlights the importance of investing in sectors that can weather inflationary periods. Companies with strong brands, pricing power, and reliable cash flows tend to perform well during times of high inflation. 4. Consider inflation-resistant assets. Investors should consider allocating a portion of their portfolio to assets that have historically performed well during inflationary periods. These may include inflation-indexed bonds, real estate, commodities, and dividend-paying stocks. 5. Diversification. Buffett advocates for diversifying investments across different asset classes and industries. A diversified portfolio can help spread risk and mitigate the impact of inflation on specific sectors or companies. 6. Stay informed and adapt. Investors should stay informed about economic conditions and be prepared to adapt their investment strategies in anticipation of potential inflationary periods. This includes monitoring inflation indicators, central bank policies, and market trends. In conclusion, we explore the investment strategies and philosophy of Warren Buffett, one of the most successful investors of all time. We discussed his focus on long-term investing, value-based decision-making, and the importance of patience and discipline in the market. Warren Buffett's emphasis on buying high-quality companies at discounted prices has proven to be a winning strategy over the years. He believes in thorough research and understanding the intrinsic value of a company before making an investment. Thank you for watching our video on Warren Buffett's investment strategies. We encourage you to delve deeper into his teachings by exploring his books, interviews, and annual shareholder letters. Remember to subscribe or follow us for more investment-related content and valuable insights from the world of finance.